A dark cloud has been hanging over the market for the past 2 weeks, and the worst may still be ahead. In today's video, I will share my outlook on where the market may be headed, the actions I'm taking with my own investments right now, and the high-quality, undervalued growth companies I'm preparing to buy next. This channel is all about investing and personal finance to help you retire early. You can also join my Patreon community for guidance to help you become a more confident and successful investor. There are 5 key factors contributing to the recent pressure on the market. We just experienced the longest government shutdown in history. Although it has been resolved with a bill extending federal spending through January, the damage is already done. Around 670,000 federal employees went without pay, and in a consumer-driven economy like the US, a shutdown of this scale has already depressed on near-term spending and GDP. This was coupled with tens of thousands of layoffs announced recently by large US corporations such as Amazon, UPS, and Verizon. Recession fears have resurfaced. The administration also indicated that because of the shutdown, October's economic data, including the jobs report, may never be released. This puts the data-dependent Fed in a difficult spot when setting policy. As a result, the odds of a December quarter-point cut have dropped from over 90% 2 weeks ago to below 50%. Finally, massive AI infrastructure spending, roughly $350 billion by mega-cap tech companies like Amazon, Meta, Microsoft, and Google has raised concerns about declining operating margins and earnings in the coming quarters. Rising operating expenses and heavy depreciation tied to these investments are beginning to pressure profitability unless companies can show clear, accelerating revenue growth in return. The Big Short investor Michael Burry recently disclosed put options against popular AI names Palantir and NVIDIA, while also challenging Hyperscaler's accounting practices, specifically the use of extended depreciation schedules that spread AI hardware costs over as long as 6 years. Extending depreciation spreads the cost over a longer time frame, reducing its impact on quarterly results. In my previous IT role, we depreciated servers over 5 years and used them for about that long. But AI servers under far heavier workloads may have much shorter useful lives. That's not all. Meta and Oracle are funding their AI capex through new debt issuance. These increases company-level financial risk and adds interest expenses that further pressure bottom-line earnings. All these negative factors would only have a meaningful, lasting impact if they ultimately connect to valuations and fundamentals. Looking at recent earnings from the hyperscalers, Microsoft, Amazon, and Alphabet all delivered a mid to high-teen revenue growth and a mid-teen to high-30s earnings growth, with accelerating cloud momentum. Management repeatedly noted that the only thing limiting even faster growth is a shortage of cloud computing capacity. Yes, AI investments are massive, but once the new computing infrastructure goes live, it's immediately consumed and starts generating revenue. This is nothing like the late dot-com era when about 90% of installed fiber set and used as dark fiber. Today's mega caps generate in average roughly $100 billion in quarterly revenue and continue to grow at double-digit rates, showing that AI spending is already paying off. Much of their capex is funded by free cash flow, further strengthening their dominance and widening their moats. However, I'm more cautious about companies that are highly leveraged and rely on large amounts of debt to fund their AI build-outs, such as Oracle. Its data center segment reportedly operates with thin gross margins due to high chip costs. With AI investments financed by debt, rising depreciation and interest expenses will further pressure operating margins and could even turn the data center segment into a money-losing business if it hasn't happened already. To measure leverage risk, I look at the net debt to free cash flow ratio. In its latest quarter, Oracle reported over $90 billion in total debt, and after subtracting cash and marketable securities, about 81 billion in net debt. Over the past 12 months, its free cash flow turned negative due to heavy capex in May and August quarters. At this pace of spending and with limited growth in operating cash flow, the company could theoretically never be able to pay down its debt. Making matters worse, Oracle is reportedly preparing to issue another $38 billion debt for its data center buildout. As a result, the massive 36% one-day stock surge after its OpenAI deal has not been completely erased. However, the stock looks poised for a near-term rebound. Meta has also been punished after management raised its AI-related spending outlook for 2026 and issued a new $30 billion bond offering, sending the stock down more than 23%. But a closer look at Meta's balance sheet and free cash flow tells a different story. Even after adding the new debt from bond issuance, net debt is only $14.4 billion. Meta still generated a strong $42.7 billion in trailing 12 months free cash flow, including $10.6 billion in Q3 alone. Its net debt to free cash flow ratio is 0.34, meaning it could take just 4 months of free cash flow to pay off all its debt. This reflects disciplined financial management and a healthy cash flow profile. Compared with Oracle, Meta is a far stronger company financially. Not all AI plays are created equal. Investors must be selective. Meta delivered an impressive 26% top-line growth, second only to Nvidia among the Mag 7. Earnings grew 20%, slower than last quarter's 38% due to higher AI operating expenses, after adjusting for the one-time non-cash tax impact from the Big Beautiful Bill. Even assuming just 10% EPS growth over the next 5 years, my intrinsic value estimate is $720, offering a 15% margin of safety compared to last Friday's close at $609. Meta is clearly a buy. From a technical perspective, the S&P 500 broke below its 50-day moving average at Friday's open but closed above it. If the index moves lower next week and falls through that support, it could test the 100-day and even the 200-day moving averages. In April, fresh tariff policy briefly drove the S&P 500 down 20%, putting the index into bear market territory. But a similar move today would require another major shock as well. Tariff tensions have eased globally, and the government shutdown has been resolved for now. The only realistic triggers for a sharp downturn would be a severe recession, or the Fed unexpectedly restarting a new rate hiking cycle. Earnings from Visa and MasterCard point to strong consumer resilience despite weaker sentiment. And with the holiday season approaching, an imminent recession seems unlikely. The Fed is also under pressure from the administration to accelerate easing, and with continued labor market weakness, I believe a December rate cut appears more likely than a pause. Therefore, I don't see any clear drivers for a major market crash unless we face a black swan event. In a worst-case short-term scenario, the S&P 500 could see a quick 10% decline toward the 200-day moving average, around 62.76. Based on my analysis of prior short-term corrections, pullbacks typically last about 15 trading days. As of last Friday, this letdown has entered its 12th day. One potential catalyst for a rebound into year-end is Nvidia's earnings next Wednesday. Estimates call for roughly $54 billion in revenue, but CEO Jensen Huang noted at most recent GTC event that Nvidia has received over $500 billion in bookings from Q4 of this year through the end of 2026, a 5-quarter span. Even assuming a conservative 70% conversion of bookings to sales, quarterly revenue could approach $70 billion, nearly doubling year over year. If this reacceleration plays out, Nvidia is also undervalued at current levels. My game plan for next week is to be ready to buy any dips. I raised cash on Friday by trimming some of my defensive positions, retailer TJX and the utility ETF XLU for a profit. I hold these names for two reasons. They help keep my portfolio balanced so I'm not overly concentrated in growth while still delivering steady returns and solid dividends, which is far better than sitting in cash. They also serve as strategic reserve capital for moments like Friday, allowing me to rotate into high-quality growth companies that are now 10 to 20% off their recent highs. Here are the growth companies I'm looking to buy, and others I may add if they drop further, summarized on one page. I've rated these companies based on their financial and operational strength and listed their intrinsic values along with one-year price targets. I shared this game plan with my private group and Patreon members last Friday so they could act quickly during the downturn. You can join them too so you don't miss future opportunities. The stock rating tool and valuation model used in today's video are also available exclusively to members. If you prefer ETFs, I would consider QQQM, SPMO, and VOO. After the market closed Friday, Warren Buffett, before stepping down as CEO of Berkshire Hathaway, revealed an unexpected new position in Q3, the tech giant Alphabet, now Berkshire's 10th largest holding. I've been accumulating Alphabet since September after the antitrust case was dismissed, and I have shared each trade with my private groups. I expect Berkshire to keep adding to this position for years, much like it did with Apple a decade ago, and I plan to do the same.